One of the biggest proposed media deals in modern Hollywood is not just a story about one company buying another. It is a story about studios fighting for survival, streaming platforms trying to control premium content, regulators questioning how much power is too much, and investors trying to extract the highest possible price from a company sitting on some of the most valuable brands in entertainment. Paramount Skydance has agreed to acquire Warner Bros. Discovery for $110.9 billion, offering $31 per share in cash. If completed, the deal would bring together Paramount, CBS, Warner Bros., HBO, CNN, DC Studios, Discovery, and multiple streaming and cable assets under one enlarged corporate structure. But this proposed merger did not appear out of nowhere. It followed months of bidding, a failed Netflix agreement, public criticism, legal challenges, and a postponed closing timeline that now depends on the outcome of antitrust litigation. To understand why Warner Bros. Discovery became such a major target, it helps to look at the company's position before the bidding war. WBD was created from the combination of Warner Media and Discovery, giving it a huge library of films, television shows, news, sports-adjacent programming, reality franchises, and premium cable assets. But scale did not automatically solve its problems. Like much of the traditional media industry, WBD was caught between declining linear television revenue and the expensive race to compete in streaming. Before the acquisition battle intensified, WBD had been planning to split itself into two companies. The idea was to separate faster-growing studio and streaming assets from the more challenged global linear networks business. That plan was meant to clarify value for investors. Instead, outside bidders saw an opportunity to buy the whole company or key parts of it before the split could happen. Paramount's pursuit began on September 12, 2025, when it started submitting unsolicited offers to acquire Warner Bros. Discovery. These early approaches were rejected, but they put pressure on WBD's board. Once a serious buyer appears, directors have to consider whether they can deliver more value by staying independent, splitting up, or opening a formal sale process. On October 21, 2025, WBD's board placed the company up for auction, saying it wanted to maximize shareholder value. That decision effectively transformed WBD from a company trying to restructure itself into the prize at the center of a corporate contest. Paramount was no longer the only player. The auction attracted competing bids from major entertainment and media names, including Netflix, Comcast, Starz, and Paramount itself. What began as an unsolicited approach became a full-scale bidding war. The first major bidding deadline came on November 20, 2025, when the competing suitors submitted offers. Then, after a second round on December 1, Netflix emerged as the board's preferred option. On December 5, the initial Netflix-Warner Bros. Deal was announced with a value of $82.7 billion. Under that structure, WBD shareholders would receive $27.75 per share, while the Global Linear Networks division would be spun off as a separately traded company. Netflix was not simply buying a studio library. It would have gained access to a historic film studio, HBO prestige programming, franchises from the Warner Bros. Catalog, and a deeper production engine. For Netflix, which built its power through streaming distribution and original content, owning more legacy studio infrastructure could have strengthened its long-term control over programming at a time when licensing from rivals has become less reliable. The Netflix deal immediately triggered a wave of concern across the entertainment industry. Critics worried that if Netflix controlled Warner Bros., it could reshape how major films move through theaters and streaming. Warner Bros. Has long been one of the central suppliers of theatrical releases, from franchise blockbusters to prestige films. Netflix, by contrast, has historically prioritized streaming access, even when it has released some films in theaters. The fear was not just that one studio would change ownership. It was that a streaming-first company could gain control over a massive traditional studio and use that power to accelerate the decline of theatrical windows and box office revenue. Theater owners, filmmakers, and competitors had reasons to worry that the balance of power could shift even further away from cinemas and toward subscription platforms. Paramount did not step aside after Netflix was chosen. By December 8, 2025, Paramount submitted a rival all-cash tender offer and continued adjusting its proposal over the following months. This was important because cash offers can be especially attractive to shareholders when there is uncertainty around regulatory approval, spin-offs, or future stock value. Paramount's argument was straightforward: it could deliver a higher, cleaner price. Meanwhile, the WBD board had already endorsed the Netflix agreement, so Paramount needed a way back into formal negotiations. That opening arrived in February 2026. Netflix granted Paramount a 7-day contractual waiver, allowing it to submit another offer. On February 17, WBD announced it would re-enter negotiations with Paramount. That move signaled that Netflix's preferred bidder status was no longer secure and that shareholder value was once again the central question. Paramount's revised proposal changed the outcome. The new offer was $31 per share in cash, valuing Warner Bros. Discovery at $110.9 billion. Compared with the earlier Netflix transaction, Paramount's bid offered a higher headline value and a clearer cash payout to shareholders. WBD's board determined that Paramount's proposal was superior. Netflix withdrew from its takeover agreement on February 26, 2026, and 1 day later, Paramount Skydance and Warner Bros. Discovery announced their plan to merge. The reversal was dramatic. In less than 3 months, Netflix had gone from winning the auction to walking away, while Paramount moved from rejected suitor to announced buyer. For WBD shareholders, the higher price was the key attraction. For the industry, the identity of the buyer raised a different set of questions about consolidation, political influence, foreign investment, and market power. If completed, the merger would create a media company with enormous reach across film, television, streaming, news, and cable. Paramount brings assets like Paramount Pictures, CBS, Paramount Plus, and a deep television production history. Warner Bros. Discovery brings Warner Bros. Film and Television, HBO, Max, CNN, Discovery's unscripted brands, and major franchises connected to DC and other entertainment libraries. The strategic logic is scale. In a fragmented streaming world, companies want larger libraries, more recognizable intellectual property, stronger advertising options, and more bargaining power with distributors. But scale is also exactly what makes regulators cautious. When two major media companies combine, the question becomes whether consumers, creators, theaters, advertisers, and rival distributors could be harmed by fewer independent decision-makers controlling what gets produced, licensed, promoted, or withheld. The ownership structure added another layer of debate. Upon closing, Paramount Skydance would be 38.5% owned by sovereign wealth funds from Saudi Arabia, the United Arab Emirates, and Qatar, although those investors would lack voting shares. Non-voting ownership means they would not directly control corporate decisions through shareholder votes, but the size of the financial stake still attracted attention. Media companies are not ordinary businesses. They shape culture, news, public debate, and political narratives. That is why foreign capital in major media assets often receives extra scrutiny, even when voting control is limited. Separate criticism also focused on the Ellison family's relationship with the Trump administration. Supporters may view those concerns as political noise around a business transaction. Critics see them as part of a broader question: who gets influence over America's most important media institutions? The regulatory process initially seemed to move in Paramount's favor. WBD shareholders approved the merger on April 23, 2026, giving the companies a crucial corporate green light. Then, on June 12, the U.S. Department of Justice's Antitrust Division approved the deal. That approval mattered because the DOJ is one of the main federal bodies responsible for evaluating whether mergers reduce competition. But DOJ approval did not end the story. Large media mergers can face challenges from other regulators, state officials, private parties, competitors, consumer groups, and international authorities. Approval by one agency can be a major milestone, but it is not the same as a guaranteed closing. The companies still needed to navigate reviews around the world and defend the transaction against ongoing legal challenges rooted in antitrust concerns. By July 24, 2026, the deal hit a major pause. Paramount Skydance and Warner Bros. Discovery agreed to halt the proposed merger and extend the closing deadline until June 1, 2027. The reason was widespread antitrust legal action and the need for more time to complete regulatory reviews and litigation. This delay is significant because merger agreements are not designed to remain open forever. The longer a deal is pending, the more risk grows. Market conditions can shift, political pressure can intensify, competitors can adjust strategy, and the target company can face uncertainty among employees, partners, and investors. A delayed merger can also limit how aggressively the companies plan integration, because until a transaction closes, they remain separate businesses that must avoid improper coordination. The court calendar made the uncertainty even bigger. On August 4, 2026, a federal judge ruled that the antitrust trial connected to the proposed merger would take place in March 2027, rejecting Paramount's request to hold it in the fall of 2026. Then, on August 18, it was announced that Paramount Skydance's acquisition of Warner Bros. Discovery would be postponed until the trial concludes. That means the deal's fate now depends not only on corporate agreement or shareholder approval, but on litigation over whether the merger violates competition law. The central issue is no longer just the price Paramount is willing to pay. It is whether the combined company would have too much power in entertainment markets. For Hollywood, this battle is a test case for the future of media consolidation in the streaming era. If you found this helpful, please like this video and subscribe for more explainers.